Hello, everyone, and welcome back to another episode of Spark Your Fire. It's Friday again, and it's our property segment again. I hope everyone's having a fantastic Friday so far. I can see John smiling, so he's definitely having a great week,
Yep.
as far as I can tell. How are you, John?
I'm very well, David. Yeah, good to see you again. Yeah, having a great week as always. Happy Friday.
Absolutely, absolutely. You just came back from a London trip, a flash trip as well, as far as
Yeah,
my
it's quick.
understanding goes, right? So, how was the London property market? Do you want to give us a quick update? Because I'm sure,
Oh,
like
no idea.
every property invest, like I can tell you, even for me, like if I go to a rural New South Wales town, I would actually go to the streets and check out the real estate office and say, how much does it actually cost
Mm,
to actually get a property here?
looking
And
for a
funny enough, a
holiday.
couple of weeks ago, I was at Lithgow, and then I can actually get properties as cheap as about $250,000, like a standalone house, two bedroom, one bathroom, very run down, of course,
Mm.
or 250. I was like, okay, well, there you go. There's a bit of information for you. If anyone's on a bit of budget, not saying you should be investing in Lithgow, but that was just one of those funny things that I thought I'll share on a Friday. So,
Yeah, well, I have no idea what the London property market's doing other than the water cooler conversation around the table as always, how expensive property is. So everyone's talking about it everywhere.
mm, yeah, I think it's just one of those general conversations that will happen everywhere in, yeah, property just being expensive in general,
Yeah.
especially. So, yeah, especially big cities. So, but yeah, look, while we're talking about properties in general, I thought let's have a chat about market observations a little bit because I know, we as real estate or property or finance professionals, I should say, we are obviously working in the real estate industry to a larger extent. So, you obviously talk to agents every day, you get a feeler from them. I talk to a lot of buyers agents. Obviously, I talk to banks as well. So, what are you seeing at the moment? I know because I know you focus in Sydney markets in particular, and
Yeah.
I know a lot of our listeners are in Sydney, so they would be very, very curious to know what are you hearing on the ground at the moment? Like, are you any interesting thoughts, any interesting things to share with us?
Yeah. So I operate all across Sydney. Just to sort of caveat my forthcoming response, I previously bought very recently in Western Sydney,
Mhm.
Bondi Beach, Inner West. So they're my immediate reference points. Um,
Big range,
so
big difference.
yeah, and it's a really big kind of range there. So what I would say is that the most um, prominent theme is that the stock has dried up. So there was a
Mm.
bit of there was a bit of a pop in February and March when everyone was excited about the supply returning to the market. That has disappeared and disappeared big. So for the first time, it's actually challenging to find properties. I mean, usually if I make enough phone calls, I'm going to find a property.
Yes.
It's not that easy at the moment. So definitely a scarcity. Um, and in some areas more than others, of course, but generally speaking, there's scarcity. Western Sydney still seems to be dominated by investors, as far as I can see. I would say, in my experience, the owner-occupier market's still dominating in, say, the inner west and the eastern suburbs,
Mm.
lower North Shore. Um, there has been a reduction in demand, I would say. This is the other interesting thing. This is hard to quantify, but there's been a very precipitous fall in supply. So there's not a lot to buy out there,
Mm.
and prices are rising. In Sydney, actually, the prices rose, and by the time this podcast comes out, we'll have the official data. But May was a good month for real estate investors. The property market went up quite a bit, um, but there has been a reduction in demand, but I think the reduction in supply is even greater.
Yeah.
So, as a leading indicator, you and I are both sort of leading indicators for the property market, probably you more than me. But I'm having a lot of inquiry at the moment. So, a lot of people are contacting me. And I always feel like when you're contacting a buyer's agent, you've given up. So, you just want to get it done. So, there could be sort of people at the end of a journey, a frustrating journey. Yeah, lots of inquiry at the moment. Not much to buy.
Yeah.
Just to add one more observation that I'm seeing, I think the feeding frenzy on the rental market is actually sort of coming to an end now. So not a market I actively engage in. So I'm not out there like
Mm.
working with renters. However, when I speak to real estate agents and um, property managers, the market has changed. It's starting to rebalance, or at least balance back in the favor of the tenant. So rents are still rising, but you're not going to see the lines out the front like we did at this time last year.
Yep.
So it felt like there was a period of maybe coming out of COVID where the rents went down, that had to readjust. That adjustment seems to be uh, mostly baked in now, and
Yep.
so I don't think we're going to see these big increases in rentals. You know, next year. I
Yeah.
think that the rental market's settling down now as well.
And do you think that's partly because of the fact that government has started to really crack down on the immigration side of things as well? So there's
No,
people basically less
I'm
demand, or
reading different things on that. So I'm reading that the verbiage, the vocabulary coming out of the government is that they're pulling down the rate of increase in migration, but I don't think the numbers really play that out. So I think migration levels are still high. I just think that there needed to be an adjustment. I just think rental prices were too low.
yeah, okay,
And I just think that that's just adjusted now.
sure.
So yes, I mean, you know, a conclusion that I've reached on the rental market, actually, if you can give me 20 seconds to, and this has come from conversations with property managers, but you know, do you remember how they, one of the reasons why I think property rental prices spiked so much over the last couple of years, definitely supply and demand and all those obvious things, migration, of course, but about 2 years ago, the government outlawed, I'm not sure the exact term, but like rent bidding or blind auctions on rentals. So if you're a property manager and you received an offer for $820, you couldn't tell the next guy, hey, I've got an offer for $820 a week. So you just had to everyone was sort of just pissing in the dark and just sort of like blindly sort of, trying to navigate their way through the rental market.
Yes.
And the solution that tenants came up with, or prospective tenants was, is because the government has made price discovery illegal, I can't ask what the last person offered and just offer him $5 a week more. Because price discovery became illegal, which is insane. Uh, what tenants did was just offer way above what
What they
the
can.
landlord was asking, just in case. So it was such a terrible law, it's totally backfired. If you've outlawed price discovery, people were just going, oh, I guess I'll just offer $50 more than they're asking. And that's one of the reasons why rental prices just skyrocketed as well, because everyone was in the dark.
Yeah. No, that's very true, mate. I think, yeah, certainly because, yeah, it's a bit like when you're making offers on a property as well, to a degree.
Mm.
Yes, there's certain guides, but that doesn't mean that you can put in as high as you like, essentially,
Yeah.
to try to win the property, right? Ultimately. So,
Yeah.
yeah, that's definitely one of the factors that keeps pushing up the rentals to a
Yeah.
degree. But yeah, I think we also, like you said, I think we are getting close to that tipping point now where it's getting to that limit in terms of how much people can afford. Wage growth is starting to slow as well, and unemployment started to rise. So I think people
Yeah.
will, moving forward, potentially be a lot more cautious
Yeah.
in that side of things. So
So what are you seeing? I think you're kind of further up the value chain than me. People come to you when they're starting their search. People come to me when they're finishing their search. So yeah, what are you seeing out there?
yeah, look, I guess primarily because my the investor type of budget that we generally look at are quite cash flow neutral / try to get positive deals. So, my clients are primarily purchasing around the 600K or 500 to 600K type of price range. And at the moment, that type of price range kind of works out quite well around Perth because the yield is still stacking up quite well there. And the other one is Townsville, which is a big one that I'm also seeing as well.
Yep.
So those are the two primary markets that a lot of people, or most of my property investor clients, are looking at getting into. And when I say Perth, it's not primarily within the CBD area. We're talking about potentially 30, 40, or even 50 minutes drive from the Perth CBD, south or north, to be able to kind of get around the price of 500K to 600K. But the rental yields has been decent. Like a lot of times, we're not seeing Perth rents starting to slow down at the moment at all. Like this like Sydney, you could potentially get a rental appraisal when you got into a contract to say maybe a 550K property is at $550 a week. By the time it settles after 6 weeks, for example, it might have gone up to about 600. And so that side of thing is still going up quite quickly at the moment. So investors are rejoicing the fact that they're still getting decent rental yields. in Perth, and at the same time, the capital appreciation is also going up quite quickly as well. So, so that's definitely a strong area that my clients are looking at. Townsville, more towards the $400,000 to $500,000, although edging more towards 500K at the moment. There's a lot less properties that's around the 450 to 400 now, just purely because of competition. So, and rents, again, the rents are also around, they're getting around the 5% gross rental return around those areas as well. So, yeah, so that's kind of where my investor clients are playing at. Very different to your market, but yeah, very busy for the last couple of months as well. The investor inquiries has been very strong. There's a lot of demand, a lot of property investors wanting to get in. And primarily, I think that's because the interest rate has stabilized to a degree. And even though, yes, there's a lot of uncertainty based on the latest CPI that just been released a couple of days ago, there's a lot of uncertainty to say, look, there might not be any further interest rate drops. As a matter of fact, some economists are saying there could be potentially an increase later this year. Who knows? But at the moment, I think we've reached to a stability point where investors go, look, I'm happy to work with the numbers that I have at the moment. As long as I understand what the cash flow is like, can I hold on to the property long term? They're willing to basically get in and try to secure a property. So that way, when interest rate does drop, and which would potentially spark more demand, they are in the front foot at the moment. So yeah. So in general, that's what I'm seeing at the moment. It's just that's still the two primary markets. Although having said that, I think Sydney units is probably one of those that's worth keeping an eye out as well. I heard you probably don't play much in the Sydney units market as much, but there are movements as well in the Sydney market prices as well. So so let alone the rents has gone up obviously in Sydney units, and now some of the areas the prices have started to catch up as well.
Yeah.
So
no, I'm a big believer in Sydney units, and it'll won't be the first time I've quoted Tom Panos on this podcast, but he quite rightly said it's cheaper to buy a unit than to build one these days. So there's an arbitrage there for sure. So a big believer. Yes, units are probably Sydney units, particularly the old walk-ups. If you're an investor, they're superb investments, and they're undervalued for sure.
Yeah, definitely. Construction costs is just basically blown out of the roof, right? So, just imagine how much it's going to cost to build new units moving forward. So that's only going to get more expensive. So good.
Yeah, there's still a shortage. We're not building enough. More people coming in. So whether it's the rental market or the buyer's market,
yes,
we still have a housing shortage in Australia. I mean, it's not as bad as it was, say, a year ago or 2 years ago, but we still have a housing shortage. That doesn't look like it's going to end anytime soon. So I think, this is going to sound cheesy, but if you're an investor investing in a big capital city in Australia, I think you can invest with confidence for a few more years.
Absolutely. Cool. All right. Well, look, that's I think that's a good summary in terms of our market observations for this time. I want to chat about, I guess, the topic today, which is we have a lot of conventional wisdoms, and we talked about a lot of conventional wisdoms in terms of investing and strategies on this podcast. But I thought one of the alternative strategy that I thought that would be worth putting on the table as well is potentially what our baby boomers have done back in the days. They purchase their own home and they basically trade up, essentially. So they don't go away and buy, a couple of investment properties planning for their future retirement, but instead what they did, they purchase their home in terms of what they can initially afford. They move into there, pay down the mortgage. In 10 years' time, let's say, for example, they've decided to upsize. So obviously they sell down the current one, they upsize to a bigger one, bigger family home, they have kids, etc., keep paying down the mortgage. And by the time when they retire, they would sell down their big home, and then they would actually trade down or downsize to a smaller unit with a big lump sum of cash available. Now, the key point here is you do not pay any capital gains tax whenever you sell or you trade up your own occupied property. So is that an alternative way to build your wealth in the long run, as opposed to the other side of the ring where we go, that's buy a couple of investment properties, hold them long time, don't sell, let inflation do its game, and by the time you retire, right, or by the time you can then decide whether you want to sell down some investment properties. But that's the other side of the fence will require you to pay capital gains tax because, of course, investment property, you make money, make capital appreciations, right? So, so I thought let's explore that two type of different, because that's kind of something that we haven't spoken about before, John. So I thought be very curious to know your thoughts and your idea or your opinion in regards to what do you think is building wealth through just constantly upsizing and just buying one property without the hassle of all the other investment property would be as viable or even more viable than building a property portfolio instead?
Right. So good question. And as with all these things, there are a number of different ways to build wealth in real estate.
Yeah.
But it's fair to say that your home, the home that you live in, is the only tax-free asset you'll ever own. And there's so much power in that. So yes, I've actually heard of people who move into a place, they renovate around themselves,
Yes.
particularly before they have kids. It's a strategy that can work. And then you sell, and then you move out, and you do the same thing in the next place. And not to name anyone, but the guy who owns, I think, I need to bleep this bit out, but the guy who owns the Hunters Hill Hotel did that very strategy. This plucky young guy moved into like self-made guy, moved into these houses, renovated them, moved his family out, and then he just stopped doing that when they had kids. I think I might be butchering the story. Super impressive. But yeah, he just figured that the only tax-free asset that I'll ever own is going to be my house, so I'm going to level up. And that's sort of a buy, renovate, sell strategy. Similar to the one you've described, which is sort of buy a property, raise your family in it, pay the debt down, and then sort of leapfrog up the value chain, which is essentially the same sort of thing. So I think it's fantastic. The only thing I'd say is it's very disruptive to a family. So if you're like a young guy, you know, it's easier to do it maybe than to be moving sort of a family in and out. The economics work though, but if it would be quite disruptive to you to be moving in and out and renovating and all those sorts of things. I should say it's not something I've ever done. I see the value in it. I've never done it. I've done the more conventional, you know, buy a house and then buy an investment property unit or something like that, and then just like set and forget. And rather than selling it to realize the upside, you refinance it to realize the upside, and that's sort of been the way I've done things. But
knowing what you know today, John, would you change your strategy?
So what I would have changed is probably to have bought more houses in Western Sydney rather than units in like the Lower North Shore. So
sorry, I was kind of more asking, like, would you, knowing
would I've done that?
Yeah, would you have done just keep upsizing, and or basically just because you would still continue to do the same thing as what you did, except just different type of assets.
Yeah, that's right.
Okay.
So I've always wanted to own a property portfolio, and if you keep leapfrogging up using kind of leveraging the one asset, or really you're leveraging the one deposit up into more valuable properties, you'd never have an asset, a property portfolio at the end. You'd need to eventually say, okay, we've made all this money, we're going to buy a house and now start investing. So you'd always have to switch to a buy and hold.
Yes.
Kind of strategy eventually.
Yes.
But I think that to grow that initial seed, it's a very good way to do it. It is a very good way to do it.
Yeah.
Because you could buy a house and then you're tapped out. You could buy one house and you'd be completely tapped out.
Yes.
So how do you get cash flow and equity? Because again, it's not enough to just have equity. You need cash flow. So that's why you have to, you know, sell these properties. So again, not something I've done, but anecdotally, I've heard it work very well for people. But eventually, you're going to need to stop because it's too disruptive. What do you think? What's your
look, yes and no. Like I think it comes down to primarily family needs to a degree.
Yeah.
You know, I haven't done it myself as well. Full disclosure, you know, we both went down the path of building a property portfolio over a big PPOR, I should put it that way. But that's not to say that can't be done. Certainly, you know, I've heard some good stories, especially the baby boomer. That's why I mentioned the baby boomer generation. That's basically what they've done. They just gone, I will buy the best in terms of what I can afford, and then I'll keep trading up as I get more money, as I move through life stages. And then eventually when I'm retiring now, you know, let's say, for example, if you do it in a property, a house in Sydney, and you managed to hold it, or you managed to upgrade, and then now you're towards the retirement age, you're looking to sell down. You got a big family home that could be worth a couple $1 million, and If you decided to sell down and trade down to a unit somewhere, maybe a 1 to 2 bedroom unit, because you don't want to be doing all the backyards and all the gardening anymore. If you sell your current home, even if you buy the current unit outright, you would still have potentially a couple millions of dollars in your bank account in that sense, right? So you would be able to retire quite comfortably. In addition to that, the pros of all this is, yes, over the years, you won't have to worry about, oh, there's tenant issues again, the property's gone vacant, oh, there's hot water system's gone, oh, air conditioning is no longer working, all that kind of issues with maintaining and having a building a property portfolio. You don't have that kind of stuff. You just go, I got one property, I got one loan that's focused on smashing this down as quickly as we possibly can. In that sense. And then, when you sell down that home and then when you upsize, you pay down, obviously you pay down whatever chunk of money, and then there's big chunk of equity that you have, and then you can then use that to trade up for a bigger property. Yes, the loan's going to go up again to a degree, but again, your profit's also gone up as well. So you got bigger deposit to be able to go up in that sense, right? So that's and again, tax-free. That's the main thing. That's probably the main thing in terms of this overall scheme. Whereas when I think about my exit strategy as a property portfolio, how do you you got to plan ahead in terms of when you're going to sell these properties, because whenever you get rid of one property at your retirement age, it could have doubled or tripled at that point in time. And the amount of capital gains tax that you're going to have to pay, regardless whether it's in personal or trust, is going to be quite significant. So that requires a lot of planning. That requires a lot of working with tax accountants. That might even require you to actually stage it out for a couple of years to be able to sell down your assets at retirement if you want to. And God knows at that point in time what the property market would be like. It's a lot less nimble in that kind of sense, as opposed to, okay, the property market's been great. Sydney is still going up and I'm willing to sell my property. Let's have a chat with a sales agent to see how we can actually get it done, right? So I guess that's one of the aspects that I thought about. It's a lot simpler for those people who don't want troubles, and they don't have a lot of time on their hands, and they don't have the ambition to want to build a property portfolio. In that sense, this would be a great way of building wealth in the long run. And I guess our assumptions here are primarily for property that's in capital cities, basically. So those that will appreciate quite significantly over the period of time. Sydney, Melbourne, Brisbane, Adelaide. You're just talking about how good Adelaide's currently being as well. So, it would work out really, really well. I mean,
the only thing I keep coming back to is I think it's a way of building wealth, but you can't eat your equity. I mean, again, this is maybe a question for you as well. When you go to the bank and you've got all this equity, and maybe you've got a house that's paid off. If you've got a house that paid off, that still doesn't mean you can borrow any money, because what they're looking for is income. And this sort of leapfrog up where you sort of, upsize, up value. It's great until you want to borrow some money, because without income, you can't do that. And that's why having the property portfolio with a bit of debt is still useful, because you've got income, and you may never need an exit plan if you've got a property portfolio. You can just go to the grave with all these, with all this income. So I think income is so valuable in this equation. Equity is but one goal when you're building a property portfolio, and cash flow and income is the other. And I think that the PPOR strategy we've talked about is very good for one of those key ingredients, the equity, but maybe not so much for income.
Yeah, not so much for the income, because you only got one property that you're living in. So you're, all the income sources just going to have to come from either your salary or your self-employed income, basically, right? Nothing to support that. Okay, so that's definitely the cons of this type of strategy, in that sense. So, but I think it's a lot simpler, and for those people who's able to manage their cash flow quite well through their own salary type of thing, then this could work out quite good. The only risk that's associated with this potentially is you are trying to push more than what you can chew. So in other words, you're trying to trade up, let's say buy a $2 million Sydney or even more Sydney house, when unfortunately your income may not be able to sustain that, and you might be forced to sell. Then that's a different story at that point in time. So you just got to be careful in terms of using this. Okay. In terms of the multi-property strategy, then what are the pros and cons of going with that? I think we touched on a few things already, as opposed to this. You know, you get multiple rental income streams, and you get a bit of negative gearing, so a bit of tax effects as
Yes.
well on that. And ultimately, like you said, you know, if you got the debt paid down, then you actually got income sources that can come in to support you as well, rather than just having your own salary or your day job as the sole income.
Yeah.
Of that. Any other pros that you would you want to highlight in comparison to the PPOR strategy?
No. I don't. I think you've named them. I think that the con is that it's a much slower strategy.
Yep, true.
So
True.
it really takes, you know, I think you've got that first 10 years of owning a property or owning multiple properties. It's really, really difficult. It's, you know, you're kind of playing this game of cat and mouse with the debt. You know, you have the direct debit, then you put money in, and you're constantly playing this sort of catch up game with the debt. But by the second 10 years, it starts to really work in your favor. And I think if you're patient, the buy and hold of a property portfolio strategy it works really, really well.
Yep. No, definitely. I think it's one of those things I think difficult to start off with, because you have to leverage up. You need to get borrowings, and you need to get quite significant debt in order to be able to build a property portfolio, right? And that's the acquisition part. And then you got the ongoing part, which is maintaining your cash flow, which is the second part, right? So you need to make sure that the cash flow side of things is good enough for you to be able to hold onto the property portfolio. And as you said, you know, let the time do the work in that case. And ultimately, 10 years down the track, yes, the rents would continue to go up. So we'll make holding a lot easier in that instance. But you got to be able to get through the first 10 years before you get to that next point. Okay. So, yeah, definitely one of the con that we mentioned previously is about staging it and getting rid of it, because you will be subject to capital gains tax as you sell down these assets.
Oh, of course. Yes. Sorry, we didn't mention that.
No, definitely. So CGT is a big factor here. And while we're advocates of holding on to property long term, I know a lot of people have made money by selling down that assets. And of course, if you got to pay the capital gains tax, you got to pay the capital gains tax. There isn't really a way to avoid it. So when you think of it this way, you know, you kind of have to hold it out long enough for it to be a worthwhile exercise. You know, take a very simple example. I bought a property in 300K around in Logan, maybe in 2014, 2015. Let's say, assume it's doubled so far. I'm a bit of a financial struggle. Let's say, unfortunately, I didn't manage my money very well. And I had to come to a decision that I had to liquidate this Logan property in order to get my savings up again, let's say, for example. In this instance, you know, the profit that I made, let's say, very simple equation, 600K, you sell for 600K, your cost was 300K. So, you know, you made 300K profit in this case. And I think you get a 50% CGT discount exemption from memory if you hold it for more than 1 year. If that's, so 150K of capital gains appreciation is still getting added onto your taxable income, if I'm not mistaken, John.
It's still taxed to the wazoo, but
still tax to the wazoo, right? So I guess how much tax you need to pay for 150K out of that, right? So
that's right.
Yeah. After you take that factor into equation, all of a sudden the profit that you originally estimated hasn't been that much. So, you know, even though if it just doubled, and yes, it sounds fantastic. All right, just double my money. But after taxman taking his share, there's actually not a lot left. So, you know, for the multi-property portfolio strategy to work, you actually need to hold it for at least maybe 2 or 3 cycles in order for it to be worthwhile.
I agree with that.
Right. So I think that's
after 2 or 3 cycles, the rent is probably worth holding it anyway. So I totally agree. I mean, the thing with capital gains is everyone thinks that the capital gains discount is like a gift to investors. But if you were to index the cost price, as we used to have to do back in the kind of 90s, you'd index the cost base to inflation. So you'd say, well, you know, I paid 300,000 for it, but really, and it's now 600,000, but most of that's just inflation, right? It's just currency debasement and so on. So if I had to adjust my cost base, as we used to have to do, are you really making a capital gain? If you adjusted the 300,000 over 10 years, it still probably would adjust to 500,000, then you're paying tax.
It's actually not
so It's the fact that most of what we think of capital gains is just inflation, and they're taxing it as it's a very cheeky way to make money.
True. So, but while I think about that, if you have, I mean, if you have a multi-property portfolio in that sense, as an alternative option to selling it down and pay the capital gains tax or pay the taxman, the other option is assuming that you haven't touched the debt. The debt is going to be a lot easier to get rid of at that point. So you could look at paying down the debt instead of selling the asset, and have potentially a property that can actually feed you income in the long run. So in other words, because until you sell the debt, until you sell the property, you're not realizing the profit. And if you don't realize the profit, you're actually not paying any tax. Well, but the rental income, you will be paying tax though. So let's say, you get 30K of rental income, you will need to pay tax on that, but at least it's still much better to have a sustainable income coming in. So I think that's definitely one of the key attractives in terms of building a property portfolio. So not the easiest approach to do, unfortunately, because you had to gear up and you had to manage your cash flow really well. But I think in the long run, and again, it's all about delayed gratification. The longer that you can hold on to the property portfolio, the bigger the return it will be. So.
Yeah, correct. Because then it's leverage on leverage, right? So it's growth on growth, and the magic of compounding. And that's why sort of holding on is kind of it's the most boring strategy of all. A multi-property buy and hold strategy is quite boring actually, and it's quite difficult to do well. But if you're patient, actually, that's where the biggest payoff is.
Yeah, I think patience is definitely one of the keys that we all have to have. So. Good. Okay. Well, I think that's it's a pretty good summary, I guess, across these two. Again, it's depending on individual circumstances in terms of what's going to be best for you. We're talking about very generic strategies here and very high level comparisons. But is there anything else, John, that you want to mention in terms of these two different strategies?
Not at all. Not at all.
Not at all. Okay. All right, excellent. All right, then I think it's pretty much a wrap for us this week. And like always, if you got any questions or anything that you want us to talk about, just send us through drop us a line or a comment or an email. Otherwise, we will see you guys again in another episode of Spark Your Fire. Cheers, John and David.